Job production slowed down over the past few months across the United States. Did the economic slowdown cool off revenue growth levels in the apartment sector, which has been really hot over the past couple of years? And we're going to take a look at that at today's episode of Apartment Market Dynamics from MPF Research. With me to do so, Greg Willet. I'm Jay Parsons, and we're going to give you today the second quarter 2012 U.S. apartment market show and tell. And Greg, normal seasonality in the leasing cycle means that Q2 is typically a big period for the U.S. apartment market. It's at a time when demand usually picks up as the weather improves. So how do the numbers look for Q2 of 2012?
The numbers are good, and let me underline that statement. The numbers are good, but what's going to get some attention here is momentum has slowed down a little bit, and particularly you see that in the rent growth stats. So let's just jump right in and talk about that. Rents up 1.2% for the quarter, a pretty healthy number, but not what we did in second quarter of last year. And so that means the annual growth pace has slowed down a little bit on pricing. We peaked out at 4.8% at the end of 2011. First quarter, we were still at 4.6. Now we're down to an even 4% rent growth number.
And Greg, we've been seeing some off-the-chart rent growth in places like the Bay Area, Boston, and Austin. And so just seeing those areas alone cool down a little bit, that would drive down the overall rent growth levels for the U.S. apartment sector. But it's not really about a couple spots, is it?
Right, and rent growth is down a little bit in those areas, but really the big story is that it's just widespread. As we look across the 100 largest metros in the country, pretty much all of them did a little bit less on the rent numbers in the second quarter of this year than they did in second quarter of last year. And as I talk to folks out there on the operations side, they've adjusted strategies on the fly a little bit. We did see a seasonal upturn in leasing activity, but maybe a little bit below what were expectations. They're concerned about the job growth numbers and potential demand as we go through the rest of the year, and they realize that we're about to get some new product going into lease up, just really in the next few months. So now it's important to play defense, and they're concentrating on stay full, even if that means you don't get rent growth quite at the level that you were anticipating a few months ago.
And if that's the strategy, then we should be seeing some pretty strong occupancy rates, and that we do. Take a look at this chart showing apartment occupancy rates for the U.S. overall. Occupancy for the U.S. overall as of Q2 came in at 95.2%. That is up 30 basis points for the quarter and 80 basis points year over year. And that's not quite an all-time high, but it is above the U.S. apartment market long-term average. And it's pretty a stunning comeback when you consider that just 2.5 years ago, occupancy had fallen all the way down to just 92%, which had been one of the lowest rates that we had ever seen for the U.S. apartment market. That's a pretty strong bounce back.
It is. And when we talk about the occupancy numbers, what we tend to focus on is the demand part of it. But really, a big part of the story is we're not yet delivering much product. So talk us through that supply-demand relationship.
Yeah, limited supply has certainly played a big role in occupancy rates of late. We're going to show you a supply chart here, and you can see that completions in the top 100 metros were held to just 19,000 units during Q2 and only 68,100 units during the past year. And with delivery numbers so small, you just don't need to see sky-high demand in order to maintain good occupancy numbers. And the second quarter demand figure in the top 100 markets was at 51,400 units, and for the past year, we absorbed 169,500 units. Now, one of the big misperceptions about the apartment market of late is that we've been seeing gigantic apartment demand, and we really haven't since 2010. Back then, we saw a lot of pent-up demand unleashed, but since then, the demand levels have been solid, but certainly not spectacular. And actually, we've been seeing demand levels trending downward a good bit. In fact, for the first half of 2012, compared to the first half of 2011, demand levels are down about 40%. Now, part of that has to do with the fact that the apartment sector is pretty much full. We're now above 95%, so there's just limited room for improvement, especially in some of the most desirable product. But the other part of it is that it's clear that operators are starting to have some concern about the depth of the demand pool.
Yeah, really a lot more we can go into here, including some patterns that we're seeing in product niche and what's happening with resident turnover rates and what's happening on the construction side. But let's save those for a little bit later in the video series and give them the attention they deserve.
That's a good plan. So before we do get any further, I want to ask the big picture question, which is, are these 2Q results, are they going to change our long-term expectations?
So we came into 2012 expecting that occupancy would go up about 50 basis points and that new rents would go up 4.5%. On the occupancy side, that looks about right. We've seen a 50 basis point shift already during the course of the year. It will get a little bit stronger in third quarter, but you tend to then give that back in seasonally slow fourth quarter. So occupancy, I think we've nailed it. Rent growth, probably we do need to adjust those expectations down a little bit. As we get into next quarter, we're going to have another big number from last year that might be a little bit hard to repeat. So it does look more likely that we will see annual rent growth a little bit under the 4% mark rather than a little bit over 4%.
And Greg, we've talked a lot about slowing momentum for the U.S. apartment market, and that is certainly important. But let me repeat the very first words that came out of your mouth, which were, the numbers are good, and we shouldn't lose sight of that. In fact, whenever we see growth levels slow down, we hear a lot of noise, typically from short-term investors, about some concerns about the market, but the numbers are good, and they still are trending in the right direction. And when we combine those shifts that we've seen in occupancy and in rents, we are seeing revenue growth levels in the 4 to 5% range. Now, that's not getting close to 6% like we had seen before, but again, certainly some good numbers. So that wraps us up for this edition of Apartment Market Dynamics. Until next time, for MPF Research and for Greg Willet, I'm Jay Parsons. Thanks for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.